Welcome to Venture Finance 101. Congratulations for taking the first step. And in this course, which is really structured as an introductory level survey course, you're going to learn a lot of things about the foundational building blocks, about how to get your house in order, about creating a compelling offer, and how to invest and be successful in the sales and marketing effort regarding venture finance. So I'm happy to introduce you to these subjects. We're going to have some fun. And the first order of business, the first step, is to make sure that you actually have the foundational knowledge. What are the periodic table of venture finance? What are the elements and the building blocks of how you can get the money you need to go where you want to go? So congratulations again. We're going to get started. First order of business, foundational knowledge. Let's watch the video. All right, so what we're going to do in this segment is go through the basic tools in the toolkit. I mean, if you think about the corporate form of organization, a company, whether it's incorporated in the US or whether it's incorporated in other jurisdictions, there are some common types of securities and instruments that can be used to help finance a company. So the most basic one is common stock. It's called common stock in the US, or it's called ordinary shares in Europe, or voting shares. And that's the basic thing that's issued to the founders and to, say, friends and family when you're trying to raise money. The next type of instrument that is frequently used, starting about 25 years ago and continuing to the present, is something called convertible debt. Convertible debt or convertible notes, basically, as its name suggested, it's truly debt, but it converts at a later date into equity. Because it's truly debt, and because debt is debt, for some people, they decided, hey, maybe we come up with something that's kind of like convertible debt, but isn't debt. And so clever lawyers, of course, came up with a new kind of security, and that's called the SAFT note, or the SAFE agreement, simple agreement for future equity. It's not convertible debt, it's not common stock, it's a simple agreement for future equity. And then there's different versions of that. So these accelerators, again, over in the Silicon Valley, another one came up with a different version of the SAFE note, which is called the KISS, or the Keep It Simple security. And that has two different versions, an equity version or a debt version. These are important because the idea here is that you'd be able to raise money without spending a ton of money on lawyers. So the standardization of the documents means that both the investors and others in the community who want to know what is it, that there is some common language around what this instrument is. More recently, with the advent of ICOs and STOs, there's an agreement called a SAFT, which is a simple agreement for future tokens. Another one that's quite popular is called the Series Seed. So the Series Seed, the idea here is that you simplify the traditional form of a venture capital financing with a set of open source documents that everybody can download, and presumably you don't need to spend as much time or money on lawyers. And the Series Seed is one that is frequently used, and versions of it exist, in other jurisdictions besides the United States. So the United States, the innovation ecosystem and the legal system, in many cases, is setting the trend and coming up with these sorts of instruments. But it's important to understand every jurisdiction, has its own laws. And so those forms cannot just be duplicated. They need to actually be modified and localized. But just to stick with the traditional ways that people do this, there's also preferred stock. And preferred stock, as its name would suggest, has a preference over the common stock. Doesn't mean that it's necessarily better. It just means that in certain circumstances, the preferred stock gets paid out first. And that can be really useful for a variety of reasons when you're accepting money from third-party investors. the preferred stock can be convertible into common stock. And we can get into how that's structured and why a bit further later, but it's important to understand that these are the building blocks. There's other ways that you can do it. You could try and maybe give somebody what is effectively a royalty in your future revenue, and those are called revenue-backed notes. So instead of giving somebody ownership, you basically say, hey, if you give me some capital, I will basically pay you back as a percentage of future revenue, maybe up to a certain amount, maybe a 5x, and then you can eliminate that debt instrument. There's ways to buy equipment. So a lot of these fast growth companies can't get financing from a traditional bank. And that's not because banks are bad. It's because banks have lending criteria, and a lot of these companies don't meet those criteria in a highly regulated environment. And so these special purpose types of banks or non-banks, financial institutions, will essentially loan money for different kinds of equipment or things like that. And because those debts are riskier, they frequently come with some kind of an equity kicker, like a warrant or something like that. So that's called venture debt or venture leasing. Those are pretty much the building blocks that have existed and have developed. And then the last one I'm going to talk about is tokenomics. When you think about the toolkit and how the toolkit has been evolving, we may have hit like an inflection point in the last couple of years in that there is a new way to engage in venture finance. It's based on a new business model in a way, blockchain and tokenization. And it started to become quite popular around 2015, 16, 17. The ICO model, which is now largely dead, but it rose and fell. It was a massive boom and bust cycle up through about the latter half of the 2018. So over $20 billion was raised through the end of 2018. When I first heard about this, which was I was working at an innovation center down in Australia, and people were saying, hey, Brad, should check out this ICO. I was like, ICO, what is it? And when it was described to me, I was like, it sounds a lot like getting a gift certificate to buy pet food at pets.com before pets.com has even built a website. And why do I say that? I mean, because essentially these tokens were saying, hey, here's my white paper, which is just a description of this great thing that I'm going to do. And if you back my project, we're going to give you this token or coin. And that coin is going to allow you to participate. You know, maybe it gives you a discount on future pet food purchases, or maybe it gives you access to a network that has certain features, which might actually, by the way, be a really good project. But we haven't actually built it yet. And so we want you to give the money now, and then later, when we build it, you'll have these rights. And so it's pretty innovative. And a lot of money was raised, like I said, over 20 billion. But unfortunately, a lot of the projects haven't materialized. There's been a lot of scams. People didn't do what they said they were going to do in many cases. Turns out the governance models weren't that great in many cases. So what happened was, you would expect, is there was a kickback from the regulators all over the world. In the United States, they basically said, these look like securities and you basically need to comply with securities laws. And you don't solve the securities problem by just incorporating in Gibraltar or Malta or Switzerland or Liechtenstein, because the securities laws, which are based on whatever country the resident resides, they dictate what you got to do. And those securities laws, unfortunately, at this point are not harmonized. So it's pretty hard to do a one-size-fits-all. It can be quite complicated. Having said that, it's a big deal. And this new breed of STOs are exciting from my perspective and will unlock illiquid assets. And actually, this is revolutionary, and it will, I have no doubt, change the world. So now you will be able to open up and unlock and basically securitize or tokenize all sorts of things, everything from real estate. Could you do an IPO of your house? If you live in, Lithuania, can you own real estate in London by simply investing in some kind of real estate token? I think you could. What about the art? Let's say you want to own and sell and trade art, or maybe you want a fractional interest in a piece of art. Could you own Monet? I mean, you could, absolutely. And so these security tokens are basically going to unleash a lot of illiquid assets. And that's important to recognize that this is a new way for companies to try and raise money. And so it's exciting, and it's probably the most innovative time period over the last 2-3 years and over the coming 3 or 4 that I've ever seen, and maybe in world history. All right, in this part, what we're going to talk about are different ways that an investor and a founder, entrepreneur can allocate things that matter to both the investor and to the founder. And effectively, you can say, okay, in some cases, there's ways that you can control the economics. And in other cases, people are more concerned about control, creative control. In terms of the economics, some of the tools that you can use to make sure that people get basically the benefit of the bargain. In a traditional sort of professional angel or venture capital backed deal, there's something called a liquidation preference. And what the liquidation preference says is that one class of security, namely the cash investor, has a preference in connection with a liquidity event, a sale of the company, something of that nature, to get their money back first. Now, you might think, well, that's not fair. Why should the vulture capitalist pig get their money back first when all the real value has been created by the entrepreneur? Has some intellectual appeal, except in a circumstance where maybe the entrepreneur didn't create any value. So let's, for example, think about an entrepreneur who raised, say, $5 million and sold 50% of the company, or let's say it's even less. Let's say it's 20% of the company. And then after using the money, the company sold for $5 million. So the investor, basically, best case scenario, is going to get a 0 return. And so why did it happen that the company didn't create value? Well, you can come up with a lot of different reasons. But the economic bargain that was struck at the beginning was, hey, you, entrepreneur, and your team told me that you were going to take the $5 million and create something that's more valuable, and it didn't happen. And so that's how liquidation preferences come into play. So typically it's just a way of making sure that the investors essentially get their money back first before everybody else gets to participate in the gain, the value creation. Tool that I'm going to touch on is something called pay to play. And it's really more of a way for the different investors to encourage the other investors to play along. And that's a tool that essentially says, look, if at a future date the company needs additional financing and you don't pay your pro rata share, well, then you're going to lose some of the preferences that you had previously negotiated. So it's kind of punishing those investors who refuse to continue to support the company in the future. That's another economic control term, but it really exists among the investors as opposed to between the company and the investors. In addition to reverse vesting on shares that are already outstanding, there's obviously vesting on equity incentives, so stock options. People are familiar with that. It's another way to ensure that you get the benefit of the bargain. Another thing that you will see commonly is reverse vesting on founder stock. And so everybody knows that starting a company is hard and it takes time. Frequently people who are involved in it go through a lot of pain and suffering. And sometimes, for a variety of reasons, one or more of the co-founders decides to leave. Maybe they got to go get a job. Maybe for whatever reason their spouse wants them to move to a foreign country. I mean, who knows what the reasons are, but the bottom line is, if that happens, then essentially the founder didn't earn the equity. And so there's periods of time, typically in the Silicon Valley, it's 4 years. So if somebody leaves with or without cause, for whatever reason, it's not uncommon that a portion of those shares will be repurchased at cost. And since at the beginning of the company's formation, the cost is low, basically they have to give some of that back. Now, is it fair? If you have to go out and find somebody else to do the job and get them motivated, yeah, essentially you don't want to pay twice for the same thing. Another thing that you will see frequently is making sure that the company has enough equity into its equity compensation pool. If in fact, as is the case in the Silicon Valley and other places that are trying to build a tech community, it's very common to have a stock option or equity compensation pool. That pool needs to be big enough to attract, retain, and motivate people from now through some time period. And that essentially is an economic thing because it impacts the value of the company in terms of the price per stock. Another thing that you'll see in these deals is something called anti-dilution. And effectively, that is a mathematical formula which looks at, okay, if we're buying shares at $1 a share and later the company sells shares, say, for 50 cents a share, then what happens? Is it everybody shares equally in that pain? Or because it looks like maybe the earlier investors might have paid more than they should have, in this case 50 cents more, is there a way to sort of reprice that earlier round? That's called the anti-dilution adjustments. It's very common, and there's lots of good arguments why that does make sense, and it's like I said, very common. So that sums up the key economic control terms and conditions that are frequently used in venture finance. So now we're going to talk about control. Everybody knows that if you've ever been in a relationship, been married, that there's certain issues regarding control of who's going to do the grocery shopping, what you're going to cook, where you're going to vacation. Those are important things. And in the corporate context, the relationship between, say, the investor and the entrepreneur also impacts the control, the creative control and the financial control over where the company is going to go. So on the one hand, obviously, the investor wants to give the entrepreneur the liberty to do what he or she thinks needs to be done. On the other hand, how crazy can they get with your money? And so there are different ways you can do it. And you can do it both by putting contractual restrictions on what they can't do unless they get your consent, and those are called protective provisions. Or you can do it through the board of directors. So let's start with the board of directors. And here I'm giving you a perspective of somebody who's lived in many countries. The corporate governance in the United States has a board of directors which has control over hiring and firing the CEO, issuing new securities, basically general policy making, and you will typically see that the CEO is almost always on that board of directors. In other countries, in Scandinavia, for example, you typically see boards of directors split between management boards and non-management boards. Down in Australia, there's different corporate governance. And being on a board not only gives you rights, it also gives you fiduciary responsibilities. And so, query whether you want to be on the board, how much they got to pay you to be on the board. But be that as it may, the board of directors, ultimately being on that board of directors is important. And so for people that are worried that they're going to lose creative control, they will, entrepreneurs will fight hard not to lose control of that board. Now, this control also can impact the economics. So we talked about the different ways that there's economics, but let's just, for example, give you a story of a situation where, okay, yeah, you agree that the founders need to have reverse vesting for 4 years. How do you get rid of a non-performing founder? Well, since the board gets to hire and fire the CEO, and the CEO typically gets to hire and fire everyone beneath him or her, it could be that 2 years into the journey that the CEO gets fired by the board, in which case not only are they out of a job, they've also given up some of the economics. So these are important things, and they work in unison. Another way that this is important, the control feature, is something called a drag along. As the name would suggest, it sounds like you're forcing somebody to do something that they don't want to do, hence the term drag along. And where a drag along comes into play is typically in an instance where somebody wants to sell the company. And when you sell the company, that's a liquidity event for some. And for others, they might not be in favor of it for strategic reasons. They may say, hey, look, why would we sell the company now? Just when things are getting good, we should go and try and turn this into $1 billion enterprise, or a $10 billion enterprise, or maybe it's 100 million. Whatever it is, you're not at that goal yet. Now, others may have a completely different view. They might say, hey, this is a fair deal. We should get out now. And so the question is, can you force people to do it? And so a drag along provision is an important one, because especially for investors that maybe didn't sign up for a 20-year commitment, if it turns out that at a point in time there is an opportunity to exit the investment, that they can force those who might not otherwise vote in favor of it to do it. Since we're looking at this as a general survey of venture finance, I would be remiss to not include some of the other terms and conditions that are frequently part of at least a venture or a seed stage financing. And those include things like dividends. Will there be any dividends, and if so, how much, and who gets to declare? Another one is redemption rights. Can you force the company to redeem your stock at some point in time? Another one is conditions on future financings. So a drip financing is one where you just continue to drip money into the company on an ongoing basis. Is there some kind of milestone where maybe you have to provide the financing, or, so there's milestone based or drip financing. In venture finance, the idea frequently over in America is give them a big chunk of change and let the dogs loose and see what happens. That's not necessarily the case in other jurisdictions, especially I find living in Europe. It's not uncommon to do more of what I guess I'd call a drip financing. So we'll give you X to get to Y, and if you get to Y, we'll give you another round, so you're doing periodic financings based on the achievement of milestones. So that's something that can be negotiated. Another one that's really important, frankly, is information rights. So what is it that you got to do to keep your investors informed? Is it once a month, once a quarter, once a year? What kind of information are you going to give them? You're going to give them financial information, audited financials. Those can be negotiated. Another feature that you will see in the venture financing stuff, which is kind of a holdover from maybe an earlier era where the idea of doing a liquidity event through an IPO seemed like a pretty realistic possibility. And so there's something called registration rights, which is if the company does go public, what right do you have to force the company to include your shares in the registration statement? In light of the fact that it takes so much longer to go public and so many fewer companies do it, that is less important than it used to be. Another key right is something called a right of first refusal. And that would be if the company at a later date is selling securities, do you have some right of first refusal to participate? In some states, that's called preemptive rights, but it can be contractually negotiated, called the right of first refusal. Then another one that can be negotiated is, voting rights or voting agreements. So this is a little bit like I mentioned these drag-along rights, but the question is, do you have, for example, the right to vote 1-for-1, or does some class have special voting rights? And do you have agreements with different shareholders to vote in a certain way? So those are negotiable. A couple of other ones that are important are restrictions on sales and co-sale agreements. Question is, if you do want to sell your securities, how do you do so? Do you have to offer it first to the company or to the other shareholders? And likewise, a co-sale agreement means if you do sell to a third party, does anyone else get to tag along on that? Another one that is very important, especially within tech companies, is the proprietary information and inventions assignment agreement, making sure that the company does in fact own all the IP that it thinks it owns. So that's an important thing, and frankly, it can be a deal killer if it's not cleaned up. So proprietary information and inventions assignment agreement, it sounds pretty innocuous. Turns out it's really important. And so it's important that everybody who's been involved in creating the intellectual property, this is really important in science and technology companies, that the company actually owns it. And if that's not true, that can be a real problem. And I'll give you a recent example. I was approached as a potential angel in a deal where the founders had something that they thought was really valuable. They'd applied for patent protection on it, and they were out pitching to try and get people to invest in the company. And when the due diligence started, and the question was, well, has everybody signed a proprietary information and invention assignment agreement? The answer was no. And which means effectively the company didn't own anything. It was just a shell. When the founder said, well, I'm not going to do that until I know that the company's got at least $1 million in the bank, because otherwise, hey, we could lose the IP. For anyone who's thinking about being part of that first $999,000, you effectively would be investing in nothing. So that's a problem. And these proprietary information invention assignment agreements, they need to be well drafted, and they need to actually be signed. A couple other things that are negotiable. One is just like there can be restrictions on the sale to third parties, there's the question of if somebody does negotiate a sale to a third party, can you tag along so you can get some liquidity? And keep in mind, these are highly illiquid usually, and how long do you have to keep your money in the company is an important consideration, and sometimes there's a desire to get partially liquid on it and maybe just keep little house money on the table, but take the original investment off. So co-sale agreements are a way to do that. And lastly, there are, for those companies that do go public, there are ways to participate in the IPO, and that can be a sweetheart deal if and when it pops up. And those kinds of things do sometimes matter more in late stage financings. There are other things that are important, like, is the founder a full-time founder? Is this a part-time job? Are they allowed to engage in other activities, things that might compete with the company or otherwise distract them? That's a negotiable item. Obviously, investors like people who are fully committed. It's a hard job to be an entrepreneur, and it's probably not a 40-hour-a-week job. So that's something that's important. There are other things that can pop up, like indemnification. So we mentioned board of directors. If you do agree to serve on the board, do you get some kind of an indemnification for your service in the case of a third-party lawsuit? That can be important. Sticking with traditional venture finance or seed finance, there's a couple more things that are just worth mentioning. One is something called a no-shop agreement. Within a term sheet, just like the company can't shop it around to third parties, the investor can't assign their right to a third party. So when you have this agreement, I mean, it's important that you know who you're dealing with. And so you can't just, it's typically not allowed to take your signed term sheet and flip it to some other investor, because that would be a different relationship. Sweat equity. People talk about sweat equity. What is it? And it's basically when you do your very best, you put in your blood, sweat, and tears to build something in order to create value. And for those who are fortunate enough to be part of the founding group, that's great, because they get in at the very first stage. They're the earliest stage, and so theoretically they benefit the most. But what about others? You want to join your team at a later stage. Other ways to do that, it's through equity compensation plans, there's stock options, and there's different ways of doing it. My experience is starting out, of course, on the West Coast of the US, this is huge. This is the way the big tech companies, the Googles, the Microsofts, the Facebooks, were able to attract the very best and brightest people. And if you were fortunate enough to be on that ride, you got rich. I mean, that's the truth, even if you were the cook. And so that myth and that, frankly, truth associated with wealth creation translates over really across the world. The sad thing for me is that, having lived in other countries, it's not as easy. Those West Coast style incentive stock option plans don't always work in other jurisdictions. Some big companies in Denmark learned out the hard way that they didn't work. And when I was living down in Australia, 2014, 2017, this was a huge issue. The share compensation scheme that the Australian government had in effect made it really expensive and hard, not just for the company, but for the recipient. So it was kind of sad. But putting all this aside, if you are interested in that, basically compensating people without paying them cash, you're giving them a share in the upside, there are really important issues, securities law issues, tax issues. So that's a very important tool if you get it right. And if you don't, then it can be a nightmare. A nightmare situation would be where somebody grants you for example, a stock option in a company, and let's say you earned it. You spent 4 or 5 years at the company, and you helped them get to this event where the company is worth a lot more, and your shares theoretically are worth a lot more. But now, if you want to exercise those shares, you have to come up with a huge cash amount in order to pay the tax bill. So what you may decide to do is not exercise it and walk away. And it's kind of sad. because people don't get the benefit of the bargain. Among the various ways that you can compensate people through equity is using, like I mentioned, stock options, restricted stock, phantom stock, which really is just giving them the value without actually issuing any kind of a security. The restricted stock one is one that I like because, at least in some jurisdictions like the United States, if you grant restricted stock, you get the benefit of starting the clock for capital gains purposes. And if there's a big difference between the tax rates, between ordinary income and capital gain, then that's a pretty big deal. Having said that, if you don't get it right, again, just sticking with the US, like you failed to file what's known as an 83B election within 30 days, that can be a tax nightmare because now the shares that are issued to you are taxable income, and every time there's a lapse in, basically every time there's a vesting event, you have more income. And so it just gets worse and worse and worse. Frankly, can lead to bankruptcy, and you didn't even get any value out of it. And so then people would try to undo it. Can you unwind it? Can you unring the bell? So bottom line is, it can be complicated. It can be great, and lots of people have gotten really wealthy and shared, almost like a socialist vision, right? I mean, if you're part of this value creation and you participate in it, and why shouldn't you? It's a great thing. But if you get it wrong, it's a nightmare. I lived in Denmark for 4 years, and it's the world's happiest country. My kids loved it. We enjoyed living there. But there is something about it that, to me, is a little strange, which is that even though it is a socialist nation, they have certain laws that don't allow and don't motivate or incent companies to grant stock options. So let's say you happen to be working for one of Denmark's greatest companies, Novo Nordisk. Do you get to participate in the value creation of Novo Nordisk? And the answer is really no. I mean, they pay well, and they have, very generous compensation schemes. But one of those is not stock options. So had Novo Nordisk been maybe a Silicon Valley-based company, you would probably have tens of thousands of millionaires who made money by participating in Novo Nordisk's growth over the last 15 years. Instead, what you have are very well-paid, happy people, but they didn't participate, and the ones who gained by Novo Nordisk's wealth creation are the owners, which is a foundation, Novo AS, and public shareholders. So it's ironic to me that a nation which is sort of socialist has put in place things that don't really give the people who are part of the team the opportunity to share in a socialist sort of way. Unlike, say, the US, which obviously is more capitalist, and if you do happen to be part of the Facebook or the Google or the Microsoft story, then you do. All boats do rise with that rising tide. Okay, another story that I think is kind of interesting as a securities lawyer and just as an entrepreneur is labor laws. In addition to tax and securities laws, there are labor laws that can also impact this. So there are some companies that thought that they could just employ a one-size-fits-all strategy by having a omnibus plan that's sort of a US-style plan, and then using that, and they were granting options to employees who were resident in Denmark. And in Denmark, when somebody is terminated mid-year, there's a concept under the labor laws that you're entitled to a pro rata portion of the bonuses that you earned during that year. And that's just the way the law works, which is great. It's very pro-worker. The question in this case was, well, the stock option plan said, unless you were employed as of a certain date, you didn't vest. So the litigation looked at the question of, well, under Danish law, do you get a portion of the options that you earned, even though you didn't hit the vesting date? And the big companies were like, no, this is obvious, no. I mean, but that's not what the court ruled. I actually know the lawyer who argued the case, very proud of it. And so they won the battle in the sense that this particular individual was entitled to the vesting of his pro rata percentage. But I would argue lost the war, because now the companies are like, great, we'll solve that problem by just not granting options. So if you don't, I think, understand the local laws and regulations, you're not going to be able to just come in with a one-size-fits-all. And a lot of companies, big companies, sophisticated companies, have learned that the hard way.